Many NRIs are confused and worried over the new income tax bill 2025 because there is news floated by some of the people that residential status, declaration, etc. had changed in the new bill, and this is severely impacting NRIs. I am receiving a lot of mails and messages seeking clarification. So I decided to make a quick video to give clarity to our NRI audience. So stay tuned till the end. If you are new to this channel, my name is Keerthi. I run a firm in Dubai specialized in NRI, tax and investing services. If you want to know more about the services offered by the consultancy, please visit www.keerthisinfo.com. In this video, let's see what has changed and what has not changed for NRIs in the new income tax bill 2025. The new IT bill intended to make law easier to understand, encouraging compliance. So the main objective of the new bill was to reduce complexity and minimize the legal disputes and encourage compliance. That's why our Finance Minister Nirmala Sitharaman said while presenting the bill that we want to move towards Vishwas over Vivad. Now Vishwas over Vivad will prevail. The new bill runs into 536 sections, 23 chapters, 16 schedules, but the content is very easy to understand. I personally feel it's old wine in new bottle. When we visit the changes in detail, you will understand why am I saying so. Now let's see what has changed in 6 quick points. So 1, tax year concept. Earlier you see there was this assessment year and previous year and everyone was confused about this. That's why the new bill it says that the tax year starts from April 1st and runs for 12 months and ends on 31st March. Have no confusion about it. Tax year is the same in which income is earned, or in other words, all the transactions and the income earned in this period, that is April 1st to March 31st, will be computed for tax purpose. Second is virtual digital assets, VDA. The new bill has defined virtual digital asset like crypto NFT. This is defined as any code, information, number or token generated through the cryptographic means and which holds inherent value. This means the government is now agile and observant and wants to be adaptive regarding all the developments that's happening in Web3. It also signals that government has a stand on crypto asset now and it wants to engage with the stakeholders in the industry if necessary and bring such assets within the ambit of financial framework. So VDA is now regarded as a capital asset, just like your land or the MF. The bill also says anyone dealing with the VDA should disclose it and the method of reporting is yet to be announced. Any profit, loss, you sell it, you buy it or swap it, all these transactions need to be reported and on this you will be taxed at 30% plus 4% surcharge. Now, third point, tax rate. The income tax rate has been revised and presently designed to make Indian sourced income chargeable with income tax up to 12 lakhs tax free with the help of tax rebates. You can refer to the video that I have already made with an example how it can help returning NRIs here. Watch the video if you have not and the link is in the description. But remember this tax rebate is not applicable to NRIs. So budget had given exemption limit up to 4 lakhs which is slightly higher now. And anyone earning around 24 lakhs plus income in India will face 30% tax. There is good news for HNI NRIs because the surcharge had been reduced from 37% to 25%. Now let's move to our fourth point, tax status. Now many of you are thinking, was RNOR really removed or did the bill change the definition of NRI altogether? Not at all. The definition of NRI is unchanged, it is retained. It is still 182 days and 60 days rule. Either you stay exceeding 182 days in the previous year or 60 days in the previous year and 365 cumulative stay in the previous 4 years block. Then only your NRI status is lost. As many NRIs are asking, 182 days are not reduced to 120 days. Even in earlier act, there was a concept of deemed residency. It targeted those who managed to stay in such a way that they didn't become tax resident in any other country. So if you have 1.5 million INR Indian sourced income, then you are not tax resident of any other country, then only India can tax you. It doesn't mean that once your stay in India has exceeded 120 days, automatically you have become resident and lost your NRI status. There is no rule like that now. Another complete misinformation and misinterpretation is RNOR status. It has not been removed. India can tax NRI's worldwide income is a lie. There is no such rule. In India, it is still residential status which is going to be base for taxing you. So now when we are discussing about tax status, we have to know about tax rate, which is our fifth point. Did anything change regarding the tax rate applicable to NRIs? No. If you have dividend income, then it is 20%. Rental or interest income, you are going to club it as Indian sourced income. And same 20% is applicable for your short-term capital gain. If you have land, then indexation benefit was taken away last year itself. For any capital asset, the long-term capital gain tax applicable is 12.5%. Now, is it must as an NRI to declare all the overseas foreign investments? Otherwise, you will be having heavy penalty and all? No. It is another misinterpretation. It is another fake news. As NRI, it is completely optional for you and nobody will keep you under the gun to disclose all your overseas earning or assets. For NRIs, there is one good news. If you have bought ULIPs, if ULIPs were issued before February 2021 and the premium is less than the sum assured, then it is tax exempt. If it is issued after 2021 February, the premium is exceeding 10% of the sum assured or 2.5 lakhs, then it is treated as capital asset. It will be taxed at 12.5%. This brings much needed clarity. Because earlier what used to happen, many people would post that ULIPs are tax exempt and only at the time of redemption people would understand that this is not exempt and we have to pay tax at the highest marginal rate. Now such confusions are gone and it is treated as capital asset and it will have tax of 12.5% subject to certain conditions. Now let's go to that sixth point. NRIs who are planning to set up business in India still are scared and unsure about the tax implications, right? Now for this you have to familiarize yourself with two concepts, that is SCP and advance ruling. So all your bias on the Indian taxation will end here. Earlier and now there exists a concept called SCP, that means if you have no office, still there is significant economic presence. Let's say your major client base is in India or you are freelancing from Indian clients, your majority of the income is coming. So in all these cases, this points towards significant economic presence and then you will pay tax in India. There is one more which can help you, which is called as advance ruling. So if you are planning to set up any venture or business in India with a resident and looking for clarity on taxation, then you can apply for advanced ruling with tax authorities. This means less dispute and more clarity. NRIs who know the power of volume game in India may think of setting up a business and scaling up a business, but what is withholding their plan? Maybe it is the tax ambiguity, right? So remove that uncertainty. Advance ruling is really helpful in these cases and it is binding on you, applicant, as well as the tax authorities. In any venture, clarity matters the most. Hope this brings much needed clarity in the video also and ends all the confusion in the NRI audience. Stay tuned for another video on NRI related topics next week. Till then, see you. Bye-bye.